I'm Charlotte McLeod with investingnews.com, and here today with me is Jeff Rhodes, CEO at Goldstrom Advisory. Thank you so much for being here. Great to have you for the very first time.
Yeah, great to be with you. It really is a pleasure. Hopefully we'll have some fun and learn something about precious metals.
I hope so as well. I think it's going to be a great conversation. And where I thought we could begin, just because it is since our first time talking, if you could tell me a little bit about your background. I know it is quite interesting how you came into the precious metal space and got to where you are today.
Yeah, I guess it is. I think probably my claim to fame is perhaps I'm maybe one of the last men standing from the brigade in the London bullion market in the 1970s and 1980s. I first entered the financial markets in 1971 when gold was still on $35, gold standard, and we still had the Smithsonian agreement on exchange rates. But it was about to end when President Nixon closed the gold window and effectively started the process of deregulating foreign exchange. And my job back in 1971 was to buy foreign exchange to pay for imports of wood pulp into the UK. And that led me to writing to the 6 banks that I worked with to purchase the FX. One of them, Sammy Montague, which is today seen as HSBC, but it was owned by Midland Bank, and Midland Bank was purchased by HSBC, I think, in the 1980s. But that was one of the 5 members of the London gold fixing, and they invited me in to see them. I'd written to say, can I become a foreign exchange trader, please? And they said no, but we did like your initiative, and why don't you join the management training program? And I'm pleased to say that by 1978, I actually joined the gold desk at Samuel Montague, and I've remained in the bullion industry ever since then.
I always enjoy hearing how people got to where they are, and so decades of experience following the gold market. I wanted to ask you how you look at the gold price, because I think you have kind of an interesting way of doing that as well, where you keep a daily price diary you're explaining to me previously. So can you go into how you look at the gold price?
Yes, can you imagine in 1978, we didn't have Reuters, we didn't have modern day technology, and you had to pick up the phone or go on a telex to people across the world to see what was going on around the world. And I was fortunate enough to have a really great guy who was a really close friend, played soccer with at Samuel Montague, who taught me how to be a bullion dealer. And that all centers around keeping a good diary. So make sure you come in an hour before the market opens and try to look at every aspect, every influence that might change the gold price, and you form a view. Because one thing as a gold trader, I have to say, you have to have a view. If you don't have a view and you're neutral, then you're never going to be successful. So he taught me to write down everything that I thought would influence the price and then come to a conclusion before starting. And then you would be bullish, bearish, or neutral. And frankly, you probably only had very good views 4 or 5 times in a month. But that fundamental, write everything down, honestly, I took that as that was my mantra. And ever since then, and even today, every day, if I'm on holiday, it doesn't matter where I am, I start the day updating, if you like, my diary, which is now, of course, on the laptop. And to the extent that through Goldstrom Advisory, we share that with our clients every day. So every trading day, including Saturdays, because people want to know what happened on the Friday. And it's amazing, just how frequently you get major moves on a Friday. I've never really worked that out. Probably there's a bit of insurance, buying or selling ahead of the weekend. And then of course on a Sunday stroke Monday, we send out a weekly review of what happened, but more importantly, what we think is going to happen. And this is what we try to do at Goldstrom, not just inform clients about what's happened, what's gone on in the last week, but where we think markets are going. And I don't do this from a point of view of being an analyst. I'm not an analyst. I'm a trader, a market trader. And what I do, I share my views, what I think is going to happen in the coming 7 days or coming 5 days. And we find the clients appreciate that, because it's all very well having a view, what is the price going to be at the end of the year? That doesn't happen. That doesn't help you on a day-to-day basis at all. So anyway, that's what I do. And fortunately, I seem to be right more often than I'm wrong. So I think I'm just scraping a pass, actually.
So you're keeping a very close eye on what's going on with the gold price, the developments that are moving the markets. What are the biggest trends that you're seeing right now? What are the big drivers that you are focusing on?
There is one big driver, and that's President Trump. You know, during his first term in office, I think I've mentioned this before, that the gold price, from the point that Donald Trump was elected as president, and congratulations to him, to the point at the end of his term in office, the gold price had appreciated by 95%. So President Trump was good for gold his first time around. Now, what have we seen in the second edition of President Trump? We saw that at one point gold this year was at an all-time record, $3,500, and on the year was up about 35%. Incredible. I mean, really incredible. And so why? Well, there were some other factors. I think a belief had been building that the Fed would cut rates this year. I think that was bullish. Obviously, the geopolitics in the Middle East extremely vulnerable in terms of crude oil and so on and so forth. So that was bullish. But I think it's the impact of, if you like, Trump tariffs on the gold market and the rest of the precious metal sector. So it really is the uncertainty that has been brought back into global financial markets, particularly precious metals, by President Trump, because I think actually is quite amazing at times. And so, you know, huge respect, but there's a tremendous amount of uncertainty. We don't know from one day or 1 week to the next. And so we have to live with that. It means volatility, but also I think what we've been seeing for a number of years now, and it seems to be accelerating, and that is dollar diversification in reserves. And I don't know whether you noted, but just this last week, gold has usurped the euro as the number 2 reserve currency in the world. So it's always obviously the dollar. And gold has been growing significantly, and it's now number 2 reserve in the world, so reserve asset in the world. So and I do think that the key driver is President Trump.
Well, and we are only just within the first year of this second Trump presidency. So for you, when you're looking at this, are you seeing that continue for the whole 4-year term, and this continues to drive gold during that time?
I think it's fair to say that the volatility will continue. The uncertainty will continue. But one of my former bosses always used to say, trees don't grow to heaven and roofs don't go to hell. And so, honestly, I think we're going to trend higher through this 4-year period. we will trend higher, but you're going to have peaks and troughs. You're going to have some volatile periods. You're going to have periods where there will be profit taking. So I wouldn't be surprised over the summer that we see slightly lower gold prices. I could easily see $3,000, $2,900. But for me, that would be a big buying opportunity. There are a lot of people who feel as though they missed the boat. I think they'll get another chance to get back on. And yeah, as I say, I think there's a good chance of that dip, but we have to take advantage of it, because I think over the next 4 years, we are going to trend higher. Where to, you might ask later, you might ask now, but I think it's inevitable that with central banks diversifying, yeah, and let me just focus on something. In US, the percentage of reserves held by the US in gold, 72% of US reserves are held in gold. And when you look at the big European countries, Germany, France, Italy, they have in the mid-60s, all of them. China is one of the fastest growing, or the biggest buyers of gold in the last few years. Its total reserves in gold as a percentage, less than 5%. And so, and the average held in gold around the world is just 21%. And there is definitely dollar diversification that is occurring. I think, you know, the actions to impose sanctions over the last few years has kind of shaken the confidence, if you like, of non-Western central banks. And there has been a move into gold from the non-Western central banks. And as I say, a good example is China. But I can just see more and more central bank buying, not crazy buying, but steady. And if you have that, and gold is now front and center in terms of an asset class. And so I think combined with private buying of gold and public buying of gold, almost is only the only way is up. And I really don't like to make outrageous predictions. It's not me. I tend to be, you know, a little bit more low key. But honestly, if you said to me, where could we be at the end of this year? I think we could have a new record high. Yeah, at the moment it's 3,500. Could easily be 3,750. But over the years following, I think a gradual increase. And it would be no great surprise that by the end of the Trump presidency this time around, we've got a price north of $5,000.
I think it's definitely starting to sound like a number that's increasingly reasonable. And one thing that I try to understand from the people that I talk to is when we look at where gold is going, what is the time frame that you are looking at for this current cycle that we're in when it comes to gold?
I think the cycle is determined by the presidency. It's 4 years. So it's a 4-year cycle. It sounds quite simplistic to say that. I hear stories that President Trump may change the head of the Fed, because if the Fed doesn't cut, maybe there could be something happen there. That would really shake markets. I think to actually take really a fantastic Fed chairman and then replace him because you don't like his policies would really shake the market. And so I think that's going to be a factor in the next few months, actually. I think I believe that the chairmanship of the Fed comes up for renewal in December. I think so. But certainly it will come up for renewal, and it will remain whether or not Chairman Powell stays in place. And I hope he does, because I think it would be good for global markets. I think good for stability. But as I say, my time frame is 4 years being the presidency. After that, who knows? And where we'll be. I think trying to predict the future that far ahead with so many uncertainties, so many variables, is very difficult. We need to have a strategy. And the strategy people, I believe, should have in their psychology is a strategy for higher precious metals prices, not just gold, but also silver, platinum, palladium, and they all dance to their own tunes. Silver is very much like gold. It is a monetary metal. It is money. Gold was and is money. Platinum and palladium are not. Platinum certainly is a mix of jewelry, but mainly from the auto sector for the catalysts, auto catalysts. And palladium also. I think there's quite an influence on platinum from jewelry. I've been hearing of strong buying from China this year, which is something like new in platinum, because the Chinese, there's a lot of demand for platinum jewelry, platinum and diamond jewelry in Asia, because that kind of the white color of platinum tends to suit their kind of complexions, and it's very popular. And certainly, we've seen platinum in the last 2 or 3 months. It's gone up by 55%. It's incredible, really, and it's gone up without any real fanfare. There's not a big driver. Although when you look at platinum, it's scarce. And that scarcity is highlighted by the lease rate. So if you wish to sell platinum short and then borrow, that lease rate is double digits. And it's been as high as 20% per annum, currently around 15% per annum. It's incredible compared to gold has a lease rate of maybe 1%. So, but platinum is interesting in that respect. Probably the most potential is in silver. Now, I said this last year. I did a podcast, if you like, one of your competitors, and I made the then outrageous claim that I saw silver at $60 an ounce this year, which drew gasps from my interviewee. But we've seen silver at $40. Right, over the last week, we've seen silver well on the way to 60. So I think lots of potential. The high price for silver historically is $50, and we've actually seen that price 3 times, well, certainly twice, and the third time was probably 49.5. But 50 is a big number, and above $50, it's technical blue sky. So, and a lot of people are buying into the silver story. I particularly like silver. 1 year, the LBMA have an annual competition at the start of the year where you have to predict the high, low, and average price for gold, silver, platinum, and palladium. And a good few years ago now, I predicted the silver price, the average silver price for the year, to the cent. And everyone asked me how I did it. It was simply a finger in the air, and I did it. But maybe for that reason, that's why I like silver so much, because I got it right. But anyway, so please, I'm taking over. You have a question, so please go ahead.
Well, you're giving away the secrets. So just a finger in the air there for silver. So there's
Mm,
clearly a lot of potential in all of these metals. And I want to go back. You're making the point that people need to have a plan on how they approach this. So for you, how every person is of course different, but how
mm.
would you encourage people to look at it in terms of allocations to the different metals, different ways that you might be able to get exposure in terms of products?
Yeah, look, I'd say every portfolio, balanced portfolio, should have an element of precious metals. I prefer physical, but equally, paper having unallocated accounts or having futures accounts, this is fine for me. I personally like the physicality of precious metals, so I like buying bars and coins. But my most preferred way of buying physical is jewelry, and particularly because you have two impacts. One, you're getting the benefit of appreciation in gold, silver, platinum, palladium, but for jewelry, it's really gold and silver. So I'd say a good way is jewelry. So all those men out there, you know, get down to the gold souk and buy your wife some jewelry. I think that would be good. But seriously, I think jewelry is really a good way to hold for just the more savvy investors. I think ETFs are good. ETFs are very good. Having, as I say, having accounts with bullion banks and bullion service providers is very good. But fundamentally, make sure that at least 10% is allocated to the precious metal sector. It's I tell you what, I look at this. It's like driving a car along the motorway. If you're driving a Porsche, it's a bit dangerous. And when the markets are Porsche type markets, then probably that allocation goes to 15% because there's a lot more uncertainty. It's more dangerous. If you then drive a Mitsubishi, it's boring, and so probably you're down below 10%. But I think 10 to 15%. But split that between gold, then some in silver, to get, if you like, silver is twice as volatile as gold. And so you get a little bit of a kicker. If you're going to be right in gold, you'll be double right in silver. So I'd always have a bit of silver. Platinum, definitely. A small amount, small, maybe up to 5% or 3% in platinum. Palladium is difficult. Honestly, palladium is difficult. And in terms of an investor, I'd see palladium as much more as a punt, much more of a kind of a gamble. I think very difficult to predict because it often behaves like crude oil. You'll see palladium following crude, but it's quite a thin market. So the most liquid market in precious is gold. I would say 85% of the value of precious metals is in gold, followed by silver, then platinum. But yeah, as I say, I tell you another question before you ask it is when should you buy?
That's a great one. We should definitely go into that.
Always, always. And why and when? Special occasions. It's birthday, it's Christmas, it's Islamic New Year, it's Jewish New Year. It's whatever celebration, you should buy gold or silver. I'm not such a big fan of diamonds because I don't understand diamonds, but I do believe gifting gold and silver at special times of the year is a very good approach to investing in gold. So you get more than one way to make money. There's another side to the market that I've been looking at quite closely recently as well, and that's coins, gold coins. New coins and numismatic coins and so on, because there again you have two ways of making money. Some would argue two ways of losing money, but two ways of making money with the underlying value of gold, but also the numismatic value of coins that you can, as I say, it's a double whammy. You can actually pick up a very nice increase in premium from time to time. So I think, and also legal tender coins are typically free of any taxation, free of VAT globally. I don't know. I really don't know about the US, but certainly in the UK, if you make a profit with your legal tender gold coins, there's no capital gains tax, and there's no VAT for legal tender coins. So I think coins, and you don't pay that much premium for coins, between 5 and 10% at times, but coins are a very good way to invest in gold, in my view.
So we've got lots of options when it comes to buying precious metals. And I like the point that you should always be buying. This is the time. When is the time? All the time. I think that
Right.
in the West, definitely we aren't seeing that. And that's another point that I wanted to go over with you, because I'm wondering when Western attitudes may start to change. And we didn't go into this earlier, but you've spent a lot of time in the Middle East, so you probably have a great idea of contrasting attitudes to precious metals.
I do actually, and it's fair to say that the gold souks of the Middle East are typically swarming with Europeans and Westerners. Honestly, and I don't think there is a woman that comes to visit Dubai and doesn't go to the gold souk. And I tell you something, gold fever exists. When you walk into the souk and you maybe have a budget of $1,000, you're going to spend two. Honestly, you are. I can tell you from personal experience, you do. And I think as populations spread around the world, I'm sure in North America, you have a lot of locals that are from Asian descent. And the same goes in Europe. And so the impact of the Asian communities in the West is actually to help take the Western markets forward. And I think another factor that is behind demand for gold is that safe haven, the physicality of the safe haven asset that's gold. And if you have bars or coins or jewelry, there are, in Europe, there have been, people have had to get up and go at times. We've had 2 world wars. And so you've never really, in North America, you haven't had that same phenomenon that you have to get up and go. Of course, in the Middle East, sadly, you see a lot of it today, and you have to take your wealth with you. Okay. Honestly, Samsonite briefcase, you can have a few $1 million worth of gold in there. And so that physicality, the safe haven physicality, is really a really important reason why people buy gold. So in Germany, there's always been a strong gold market. France, really a strong gold market, because in the heart of Europe there were 2 world wars. So and then let's turn to India. In India, they've been buying gold for 2,000 years. And in those old days, the farmers, they used to, when they had a good harvest, they would put the money into gold. And there was a lot of internal fighting between the kingdoms in India. And so when that fighting took place, you'd see the farmers would be burying their gold in their ground, in their fields, and run away, then come back when everything calmed down. And so that kind of safe haven belief in gold is so entrenched in not just Asia, but, as I say, for me, a big part of Europe as well. And that's a major reason why you go, because I tell you a story. So it's a story about a story, and it's probably a bit of a truism. I attended a really good conference in Australia a good few years ago, and the person giving the presentation, he talked about the Russian Revolution and what happened there, and he got this big banknote, like a white Russian ruble banknote, right, big thing. And it said, so when everything was going on in Russia, the rich people decided they would have to go and they take kind of liberty passage to the US. And a lot of them packed their suitcases with banknotes, and a lot of others packed their suitcases with gold bars. By the time they got to the US, to the Liberty, the White Russian ruble had been cancelled by the revolutionary government to come in and cancelled the currency. So those suitcases full of paper were worthless. Those that had taken gold bars were obviously proven correct. So that, as I say, is a bit of a truism, but is a very good way to explain that the safe haven physicality of gold, that gold physically can buy you goods and services anywhere in the world without electricity, without, your ATM card, without, using your Apple phone to pay. Gold, when you have problems, gold will be that asset that gets you out of trouble.
It's a very illustrative story, and I think sometimes people do need an example like that to really grasp it. So thank you for going into that. I think we've covered a lot of ground in the precious metals markets, but before I let you go, do you have any final thoughts that you would leave investors with? As we said, it's kind of a tumultuous time that we're going through right now.
Yes, I think to be confident. I think generally the markets are heading in the right direction. Although we've got a lot of problems in the world, equity markets are doing well. I mean, relatively well. I think probably we're going to see slightly lower interest rates. I think the pressure is down. The PPI data today was lower than expected, so I think that will give a boost to prices. But I think play from the long side. Be prepared to take profits when it looks good, but generally adopt an approach, buy into dips, always buy. Don't try to play the markets. Just buy on a regular basis. Almost have a savings plan where you put so much of your money, of your disposable income, into the safe haven of gold, silver, to a certain extent platinum, but certainly gold and silver, and do it on a regular basis. I would encourage investors to look at the physical side of the market, because I do believe that's being validated by under Basel III. Banks holding physical gold can treat that gold much, much better in terms of its value compared to unallocated gold, which is seen to be a risk asset, whereas physical gold is seen to be a risk-free asset. And so I think the banking world is seeing gold more and more in terms of its physicality. So I'd encourage people to be confident in gold, confident in silver and platinum, be cautious in palladium, but generally don't overdo it. Maximum exposure, maybe 15 to 20%, and then see that as an insurance asset as well. So you insure your health, and you insure your car, and you insure your house. You insure lots of things. You should insure your wealth with gold.
Well, I think that's a really great place to wrap up. So thank you so much for coming on to go over what's happening in gold as well as the other precious metals. It was great to have you.
Thank you very much. It's been a pleasure talking to you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Jeff Rhodes with Goldstrom Advisory.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.